You're on AM 740 KVOR with Accelerated Wealth with Chris Abeyta and Doug Berkey, where you get retirement confidence in an uncertain world. This is National Annuity Awareness Month, and today I want to talk about our guest, and we're going to talk about annuities as well. Now, some people, maybe you've heard they hate them. Other people absolutely love them and can't imagine living their lives without them or going into retirement without a guaranteed paycheck for their entire life. But the question is, do you really understand what they are and how they work? And I'm talking about annuities today. And today's guest, he's the author of the book, Pensionize Your Nest Egg, and he knows them inside and out. Today, author Moshe Milevsky, he will give you the true clarity on what an annuity is and what it's not. And before the bottom of the hour, you'll know if you're a good candidate for using a centuries-old tool for your retirement plan. Now, just a quick story about annuities. Everybody remembers Babe Ruth, the famous baseball player. He played back prior to the Great Depression, made a lot of money probably as a baseball player, but something happened in the Great Depression. He lost all of his money when the stock market crashed in the Great Depression. The only thing he didn't lose was his safe annuity that he had. And it was his annuity that continued to pay him paychecks and kept him from going completely bankrupt, because it was protected from the stock market, and it gave him lifetime paychecks for as long as he lived. And so just an interesting historical fact and story. We've got some others about those, but let me tell you about Moshe. He is a professor of let me see if I can pronounce this right, the Schulich School of Business at York University. He's also the managing director of the Longevity Extension Corporation, which is focused on helping pension funds, endowments, and retirees extend the longevity of their investment portfolios. So he's consulting into pensions. Maybe if you've got a pension, he may even be speaking into that to make sure to help it last as long as you do, to make sure you keep getting paychecks. He's published over 12 books, way too many articles to even mention. He's written for the Wall Street Journal, The Globe, The National Post, and Research Magazine, where he received the Retirement Income Industry Association Lifetime Achievement Award. And so, Moshe, it's great to have you here. Thanks for joining us today.
Yeah, thank you. Appreciate the opportunity.
Oh, you bet. Hey, let's get right to it. Not everybody knows what an annuity is, so help us out with that.
Yeah, the word annuity has become almost a meaningless term at this point. It's sort of like the word fund. You can have mutual funds, exchange-traded funds, hedge funds, discretionary portfolio funds. The word fund means nothing. If somebody were to say to me, hey, Moshe, do you like funds? What do you think about funds? I mean, it's an empty question.
Yeah.
There's really nothing to say.
That's a good way to put it.
The same thing now applies with annuities. There are so many different types, and there's so many instruments that are using the word annuity in them that it's almost impossible to opine on whether something is good or bad. Is this a good one for you, a bad one, or what they even mean. The word annuity can represent just a series of payments. Cash flow has nothing to do with insurance. So you really have to narrow down, and here's the practical side. When somebody says to you annuity, or do you want an annuity, or are you interested, you have to really get more specific. What kind of an annuity exactly? And then you can start talking intelligently about, does this make sense? Is it the right point in my life for it? Should I get one? But the word annuity alone doesn't mean anything.
And I agree with you, because we run into all kinds of people that they have this preconceived idea of what an annuity is, and most of the time they're not accurate. In fact, almost all the time they're not accurate. They just think it's my grandfather's annuity. He got payments, but if you die early, somebody else keeps all the money. And when we explain to them that's not the case with certain types of annuities, their shoulders drop and they go, oh. And so it's amazing the perception that is out there. So tell me, define what is not an annuity?
Well, let me start by defining what I like about the annuity, or how to identify a proper annuity, and then we can talk about the many, many things that aren't annuities. To me, an annuity is a pension.
Okay.
To me, an annuity is an instrument that you buy slowly or perhaps all at once, and this guarantees you a pension for the rest of your life as long as you live. Think Social Security. Think corporate defined benefit pension plan. Think something that will provide for you in your old age. That's what an annuity should be, and that's what an annuity was originally designed to do. The closer the product you're looking at is to that ideal, a pension like Social Security, the more you're entitled to say, yeah, that's an annuity, it makes sense, it's a good idea. The farther and farther you get away from that, the less these products make sense. And I think that's really, the 30-second summary of how to know if you're looking at a product that makes sense for you and how to know if you're looking at something that, really wasn't designed for that.
Tell me about your book, Pensionize Your Nest Egg. Help us understand, what's the premise of your book and why did you write that? And what does that mean to pensionize your nest egg?
Yeah, the book, Pensionize Your Nest Egg, it's actually a second edition, just came out last month. And that book is meant to help the many people, not just in the U.S., but around the world, that are now facing a situation where they arrive at retirement with a sum of money, but no pension. They have a large sum of money in their 401k or their IRA or their corporate savings plan, but they don't really have a pension. And what we're trying to do in this book is to help people convert their sum of money into something that provides lifetime income. You may have hundreds of thousands of dollars in your 401k, but that's not quite a pension. You still have to do something to convert it into a pension. And that's really what this book is about, how to convert that sum of money into a pension.
How long have annuities been available, Moshe?
If you look back at, again, the word annuity representing pensions and income, hundreds of years. In fact, I've published 2 books this month. It's sort of odd timing, but the other book that I have recently published by Cambridge University Press is on the history of retirement annuities, and they've been around for hundreds of years. In fact, the British government and the French government in the 16th and 17th century used these instruments to finance their wars. Governments, parliament needed money. They had to raise money. Nowadays, you'd think that they'd issue bonds, and that's what governments do today, but hundreds of years ago, they would issue annuities. They'd go out to the public and they'd say, hey, we need £100, we need 1,000 francs, give us the money, we'll give it back to you slowly for the rest of your life as long as you live. In your old age, you'll get that money as well. We need the money now. And eventually, governments got out of that business and insurance companies took it over, but these instruments have been around for hundreds of years, and financial advisors have hated them for hundreds of years. When I was doing research for this book in the archives in London, there's documents that I came across that were written 200 years ago where a financial advisor, there were financial advisors 200 years ago, was writing a note to a client of his saying, you don't want to buy an annuity, it's not a good idea, you want to buy stocks instead, it's a better investment. So this visceral reaction against annuities have been around for hundreds of years, and I won't be surprised if they'll still be around for hundreds of years.
That is so interesting. If you just joined us, we're talking to Moshe Milevsky. He is the author of Pensionize Your Nest Egg. And I want to go back, Moshe, to something you said. Most people, they've been saving in an IRA, 401k. They're getting to the point where you get closer to retirement. The stock market is at an all-time high, and they have this pile of money, but they don't know how to actually turn it into an income. And it's a conundrum. It is a huge, it's an area of uncertainty and dissonance for a lot of people because for their entire life, they've been putting money away, hoping that it grows. They've seen their stocks, bonds, and mutual funds in their accounts drop in half, maybe twice in the last 14 years, and the 2000 crash, and then again in 2008. Now we're back up, and people are asking that question again. How do I convert and turn this nest egg that is supposed to take care of me when I cannot work anymore? How do I convert that into income? Tell me. That's the thing that we run into all the time. Of course, that's what we do is we help people do that. But I want to hear from your perspective. Why is it so important? And how should people be pensionizing? Do they pensionize their entire nest egg? Do they do a portion of it? Tell us your thoughts on that.
Yeah, so there's a lot going on there. I mean, first of all, let me agree with you 100%. The way I like to say it is that your 401k or IRA is a number, and it should be a big number, but what you do with that number is more important than the size of the number itself. What I mean by that is if my neighbor has $200,000 in his or her IRA, and I have only $100,000 in my IRA, how I actually allocate that $100,000, what sorts of products I buy, will actually determine how long the money lasts, and it's more important than the number itself. So my $100,000 may be much more effective than his or her $200,000 because they're just not managing the funds effectively. They're investing in the wrong things to generate retirement income. So in response to your original comment, it is very, very important to get down the mountain, so to speak, not just get up the mountain. You're getting up the mountain, you've saved money, you're at the peak. Now it's time to bring this money down and to bring it down in an effective way. How to do this is something that's very difficult to summarize in a 60-second soundbite.
You know what? We're gonna go to a break here, and we're gonna come right back on how to get down the mountain. You've got up the mountain with this huge pile of money, and hopefully it's huge. The question is, how do you actually get down the mountain safely and make sure this money lasts for you as long as you are alive? You're listening to Accelerated Wealth with Chris Abeyta and Doug Berkey on AM 740 KVOR. We'll be right back.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Moshe, we left off that break there asking about how do we get down the mountain? Once you've saved your entire life savings and you go into retirement, how do you come back down?
You know, I think that getting down the mountain isn't just about the investments that you hold, it's about the products that you hold, and those are two very important issues. You know, investments are stocks and bonds and mutual funds and ETFs and so on. Products are things like insurance policies, annuities, life insurance policies. Obviously, long-term care is a big part of the story, as well as the spending rates. And I think that one key is that you have to start thinking about coming down from the mountain well before you've reached the peak. The last thing you want to do is show up at the peak of the mountain and say, all right, now how do I get down? You want to start thinking about this when you're still ascending the mountain. I would say 10, maybe even 15 years before you start pulling money out, you have to start thinking about the products that you're going to purchase and the strategies you're going to employ in order to do that. And I think if I could summarize all of this, is it's got to be done strategically and it's got to be done slowly. You don't just wake up one day and say, all right, now let me revamp my entire portfolio for retirement. That's not the way to do it. You have to do it slowly.
Moshe, you used to be a critic of annuities, as I recall. What made you change your mind?
You know, I think, again, the word annuity doesn't mean very much. So there were certain aspects of annuities that I wasn't a big fan of. In particular, there were old-style annuities, this was 20 years ago, where there wasn't really very much that was guaranteed. People were not buying them as pensions. They were certainly not buying them for retirement income. There was a very, very thin layer of life insurance. They were relatively expensive. They were meant as tax shelters, but people were putting them in qualified plans, which made no sense to me. Yep. So I was very vocal about the fact that in that particular circumstance, they make absolutely no sense at all, and I certainly wouldn't recommend them. Front forward 10 to 15 years, these products have really changed. They're now geared towards creating an income, pensions, guarantees, downside that's limited, upside participation. They've changed very much from their nature as tax shelters, and in fact, recently the U.S. Treasury announced that they'd like to encourage qualified plans and 401ks to offer these annuities because of the decline in defined benefit pensions. So here we were 15 years ago, the government was criticizing them, and now they're actually encouraging putting them inside of qualified plans. So it's not just me that's changed my opinion. I think the overall perception of them has changed as well.
Well, and that goes along, Moshe, with the facts that last year baby boomers are coming in droves. They're exchanging their mutual funds or a portion of their mutual funds or stocks and bonds and moving into certain types of annuities. And last year I saw a fact that $47 billion moved out of the stock market into fixed indexed annuities that are specifically designed to create paychecks for people when they retire, basically pensions.
Yeah, I think that's good news as long as it's done in moderation and it's not done all at once. I think that anybody that takes their entire mutual fund portfolio and sells its entire portfolio and does this all at once at one day, it's questionable. But a portion, I like to use the word product allocation. We know what asset allocation is. It's mixing investments so that when one zigs, the other zags. Product allocation is mixing different products in your portfolio, and an annuity should be part of it, like a vitamin. You don't want to only have vitamins all day long, but you have some of it, and you have it at the right time, and it can increase your energy.
You know, that is so true. One, you'd never want to dump your entire nest egg, I totally agree with you, into one product. But you just made a huge distinction between asset allocation and product allocation. That's a big. Explain that a little bit more, because a lot of times we work with people, and our listeners that are listening right now, they may think, well, I've got an asset allocation, I'm diversified, but they're all in mutual funds, different types of large cap, mid cap, small cap type of mutual funds. They believe they're diversified, yet they have no product diversity.
Yeah, you know, diversification is a fuzzy topic because if you have all of your securities in the same industry, you're not really very diversified. It's not about the name. It's not about the number. It's about the factors. What are they sensitive to? So, you know, diversification is not something that's easy to identify. It's hard for the naked eye to see it. You have to really run through some analytics and say, yeah, it looks like when this goes up, the other one goes down. I have diversification.
You know, if you've just joined us, you're listening to Accelerated Wealth. We're interviewing Moshe Milevsky. He is the author of Pensionize Your Nest Egg. and used to be an enemy, I would say, of annuities, but now is a proponent of having, would you agree, Moshe, of the right kind of product and having the right kind of annuities for pension purposes. Give us an example of the difference between a bond and an annuity. A lot of people think that they move more into a conservative approach in their asset allocation mix as they get older by having more bonds. But how do those compare to annuities in replacing bonds in that asset allocation?
You know, and I don't want to veer too far from the scheduled topic here,
Sure.
but bonds are very tricky in this environment because of where interest rates are heading. You know, if you think about bonds, they do sound like they're guaranteed. They pay you an income. They pay you an income until the bond matures. But when interest rates move up, and especially long-term interest rates move up, those bond values decline. The net asset values, the values that you're going to see reported on your statement, will go down. So even though the income may not decline, you'll still get the monthly or quarterly or semi-annual coupons, the value of your holdings will decline. So we're in a bit of a catch-22 right now, because as baby boomers age, as people get into their late 50s and 60s, people are being told, you know, you're getting older, you should hold more bonds, you have to be safer, which, you know, is good advice at the face of it. On the other hand, we also know from the other side of things that interest rates, especially at the long end, are likely to head up soon. You know, Federal Reserve, Janet Yellen, the discussion is that eventually interest rates are going to head up, perhaps sooner than later, and those bonds are going to take a hit. So it's a little bit problematic to tell people go out and buy bonds as an alternative to your risky stocks in an environment in which bond prices are expected to decline.
Exactly.
This is why I think that having some sort of annuity holdings, which are bonds, but they also have additional benefits because of the mortality pooling, I think that that's sort of a compromise in this environment. And again, I don't want to get too technical on a radio show,
Sure.
but when you buy an annuity, you're getting some of these mortality pooling benefits that a bond wouldn't provide.
Many of our listeners are between age 60 and 65. What percentage would you recommend? I know it's a broad question, potentially in an annuity. Every situation's different, but as a general thought.
You know, I would start off by saying that if you're in that age group, delay Social Security as long as you possibly can, because you'll be buying an annuity by delaying Social Security, and you'll be buying a real inflation-adjusted annuity at a really good price. So if somebody comes to me and says, okay, you know, I'm 63, I'm trying to figure out how much of my nest egg to put in an annuity, I would say, stop. Let's take a look at what your Social Security benefits are. You might want to wait a couple of years. You'll get bigger benefits. That's your annuity. Now, if they come back and they say, you know what, that's not going to be enough annuity income, or, yeah, I'm delaying anyway to the age of 70, then I would say, okay, let's take a look at what your income needs are. Let's cover them with some sort of guaranteed source of income. So let me try to answer your question in this way. When we talk about stocks versus bonds, the inclination is to say 60 stocks, 40 bonds, asset allocation mix. When it comes to annuities, you want to work backwards from your income needs. You don't want to start with what percent allocation. You want to start at the end and say, okay, what are your income needs? You want to cover those with some sort of guaranteed product. Does that make sense?
Absolutely.
Oh, completely. And this is the big shift. And do you see this as well, Moshe? It's a major mind shift for people to go from, I own this much of a mutual fund and maybe or stocks and bonds, and this is my rate of return that I got last year, compared to I'm now making a shift into taking some of my nest egg and committing it to create lifetime income or a pension.
Part of it is, and I blame here, pie charts. You know, the pie chart view of investing. This is your money, and you have to have 30% here and 40% there. We've all used to pie charting things, and I think that when it comes to retirement income planning, it's part of the change in mindset. You have to start thinking in terms of income, which is an important exercise to do independently because you want to make sure you can afford retirement. And I think that's really the eye-opener. For many people, the benefit that comes from this exercise is realizing, wow, that's how much I need in order to maintain my standard of living? Well, maybe I should work a little bit longer. Maybe I should save a little bit more.
Well,
the income exercise forces you to do that.
You know, and income is where it's at. If you don't have income, you're not retired. If you don't have money to spend, you're not surviving. You're not alive. You're not having fun. And that's very different than when we sit down with people, and maybe you're listening right now, and you have your pie chart. You've got stocks, bonds, and mutual funds, and one of the questions we ask is, how much income is your portfolio, your pie chart, going to produce when you retire? And not just how much is it going to produce, but how long will it produce that? And do you have any idea? And that's the uncertainty that you can't derive from stocks, bonds, or mutual funds. And that's why it's so important to say, how much income do I need over and above my Social Security? and how do I pensionize a portion of my nest egg to actually get the income I'm going to need that will take me and my spouse all the way through retirement. If that's something that you're interested in and you want to find the right tool to create a pension, the right type of annuity to do that, give us a call. The number's 466-5634 for the first 10 callers. What we are doing today is Doug and I will sit down with you. We will create our 5-basket master retirement plan, and we're going to work backwards. Exactly what Moshe just said. We're going to take a look at your income. We're going to take a look at optimizing your Social Security. We're going to find your gap, and then we're going to work backwards and help you fill that gap for you and your spouse, and we're going to show you how to guarantee that income for the rest of your life. If you're interested in that, give us a call. That's that 5-basket retirement master plan that we'll do for you. It's customized specifically for you. It's not something we can mail to you. We have to sit down and build it specifically with you and for you. The number's 466-5634. That's 466-5634. Moshe, it's been great having you today. Is there anything else you'd like to share? One question I have for you is, when would you buy an annuity? Do you own one, or when would you buy one?
I do. I actually bought one just before the financial crisis. Of course, at the time, we didn't know the financial crisis was coming. I liked the guaranteed income, the terms that were being promised, the annual ratchets and roll-ups. So I have one of them, and, I get closer to retirement. I certainly consider myself someone that's young and working right now, but when I get closer to retirement or the top of the mountain I mentioned earlier, I plan to acquire a bit more. It'll be part of my retirement income portfolio. Not the whole thing. I don't live on vitamins. I will have some of these vitamins. There's other things I'm going to have in my portfolio.
Well, my wife and I own them too. We're young as well. How can people get your book?
Well, I presume Amazon and Barnes & Noble and various bookstores online sell these books nowadays. They're widely available in bookstores, so I guess that would be my advice for people who want to learn more about this.
Great. You go to Amazon. That's How to Pensionize Your Nest Egg. Moshe, thanks so much. I know you've got a meeting to run to. We appreciate you joining us today. It's been great having you.
Yeah, my pleasure. Thanks for the opportunity.
Hey, coming back at the bottom of the hour, we're going to come back in. We're going to talk about if you already have this type of annuity, it is poison for your retirement plan. And we're going to show you why and what you can do about it. This is Chris Abeyta and Doug Berkey with Accelerated Wealth. You're on AM 740 KVOR. We'll be right back.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Hey, welcome back to Accelerated Wealth. This is Chris Abeyta and Doug Berkey, your hosts, where you get retirement confidence in an uncertain world here on AM 740 KVOR. Now, right before the break, I mentioned to you there's a certain type of annuity that if you're holding this in your portfolio, it can be poison to your retirement plan, your portfolio, your retirement strategy. And we're going to get to that and tell you what kind of annuity you don't want to have. We're going to talk about the kind of annuities that you do want to have. And the difference is you. The difference is how old you are. The difference is if you're married, if you're not married. There's no cookie-cutter approach to just buying an annuity. You have to find the one that is specifically designed or best suited for you. And one might be better designed for you, and a different one might be better designed for your neighbor or your coworker at work. But it really depends on your situation. That's why these are customized strategies and not just product-based approaches, But before we dive into that, I want you to think about this. The stock market has been on a tear for about over 2,200 days going up. We're seeing all-time highs. And right now, this is the third largest bull market in history. And maybe you've been getting close to retirement. Maybe your nest egg has been increasing, which is fantastic. Your IRAs, your 401ks are at all-time highs, better than they've ever been before. But here's the question. The question is, when is this party going to end? And when it comes crashing down, how much can you afford to lose? If you've not taken steps to protect your nest egg and really begin to think, how much income will my nest egg produce, and will I be safe and secure? If you're concerned about that, the time right now is to protect yourself now. And what Doug and I offer is a 5-basket master retirement plan. Now, this is a customized plan, and here's what you'll discover. Number one, we're going to show concrete steps on how to protect your entire life savings, those IRAs, those 401ks, to keep them from crashing down into a 201k. We're going to show you how to build rock-solid retirement income. No matter what happens to the stock market, whether it goes down, you're going to be protected and guaranteed. We'll also show you ways that when the stock market is crashing down, how you can actually be out of it and your accounts actually going up when the market is going down. and also why so many plans fail today. And we're going to show you inside your retirement strategy right now, there are probably areas where you have thousands, maybe even tens of thousands of dollars a year leaking and just falling through the cracks. We're going to show you how to stop that, how to redirect that money back towards you and use it for you and your retirement. So here's what we're offering. To get your free customized 5-basket retirement plan, be one of the first 6 callers. You have to be one of the qualified callers. Give us a call, 466-5634. That's 466-5634. We'll walk through, we'll sit down, we'll customize a strategy for you. We don't charge for it if you're one of the first 6 callers. Again, that's 466-5634. Now, Doug, let's talk about the types of annuities that there are. And there are right annuities and there are wrong annuities. And like I mentioned earlier, one might be right for somebody, another one might not be right for the person next door. So what are we looking for when somebody is out there? They've heard about annuities, they've got misconceptions about annuities, they don't understand them. What are they looking for? What are the things that we want to have in an annuity in our portfolio?
Well, there are a number of features that you would especially want in your annuity. One is protection against principal loss, Chris, so that you can't lose a penny in those accounts. And so that's probably the key ingredient. Another I would want to see in my annuity is something called an annual reset feature, which means that this year's or last year's profit becomes part of this year's guarantee. So every time I get a gain in my annuity, it also has a principal guarantee in it.
So unlike a mutual fund, when the stock market crashes down, you're saying in this type of an annuity, you don't lose anything.
That's right. That's right. Another thing I would look for is low or no management fees in my annuity. And that's a consideration because that can act like a headwind against you if you have significant fees, as the poison product that you talked about tends to have.
So what's a low fee? What's a high fee?
Well, low would be close to 0. High would be 3.5% to 4%. Which is not uncommon.
Yeah.
And then another thing that you would look for is you want guaranteed income for life, preferably set up as a joint annuity, Chris, so that both you and your spouse are guaranteed income for life, no matter how long either of you live. And then whatever happens to be left when the second person passes also goes to your beneficiaries. Unlike most company pension plans, that when the second person passes, that money is kept by the company.
That is so important, and I think you're really hitting a bigger piece here. You don't just go out and just buy an annuity to add it to your product portfolio, okay? Here's what you really need, Doug. You said hit some really important points, and one of them is if you're going to buy an annuity, the question is, do you have any, or do you just have stocks, bonds, and mutual funds? There's a MarketWatch article that just came out a couple years ago. It basically says, if you're moving closer to retirement, if you're in retirement, seniors need more annuities and less stocks. Interesting, Putnam just did a study not too long ago after the market crash. This at Putnam, the mutual fund company.
The big mutual fund company.
Yeah, the huge mutual fund company. What did they say about annuities? What they said about mutual funds was you should have no more than 10% of your nest egg in stocks, bonds, or mutual funds, if you're depending on that money for retirement. This is a mutual fund company. So you have to ask yourself right now, what percentage of your nest egg is actually in stocks, bonds, and mutual funds? Is it more than 10%? Is it more than 25%? Why would a mutual fund company be telling you that you should have no more than 10 to 25% in their products? Why?
Obviously, they must not think it's appropriate for you at retirement age or close to retirement age to be carrying that much risk. Is this what your broker's telling you, Chris? Is that what you're hearing from your broker to reduce your positions in the market? I don't think so.
You're probably not. And like I started earlier, what happens if there's another 20 or 34%, 30 or 40% drop in the stock market? How much money can you afford to lose? And what our guest, Moshe, was saying is the reason you put a portion of your nest egg into an annuity is to determine how much income you're going to need over and above Social Security and any pension that you might have in retirement. And so it's a strategy. And so if you don't have that and you're interested in getting our 5-basket master retirement plan, be one of the first 6 callers. The number is 466-5634. That's 466-5634. We'll walk step by step with you. We're going to walk through a process to show you how much income do you need in retirement, how are your assets going to generate that? And how can you make sure that the income that you need in retirement is actually going to be guaranteed no matter, regardless whether the stock market goes up or if it crashes down, you'll be in a secure position. The number is 466-5634. That's 466-5634. Be one of the first 6 qualified callers. Now, here's a question. What do you need? Let's talk about what you need. And I just want to reiterate that, and then we're going to go right into, there's another T-row price. So let me just bullet these if you missed these. What do you need in your annuity? If you're looking for an annuity right now, number one, you need an annuity that's going to fit into an overall plan that's going to provide the income for you for life. This is not, I just need to go buy an annuity and I hope it fits in my plan. It needs to fit in a well-designed strategy and a plan that's going to bring you peace of mind. That's number one. Number two, you want one that's going to provide a guaranteed paycheck for life, a pension. You're basically buying a pension that's going to provide income for you. It's going to provide income for your spouse for as long as you are alive. Number three, it's going to be protected from the stock market. So when the stock market crashes down, you lose nothing. You lose zero if you're in the correct annuity. Okay, when the stock market goes up, you participate in the gain, but when the market drops, you lose absolutely nothing. Your principal is protected. Doug, you mentioned low fees. We have certain annuities that have zero fee. Some of the ones that we use are between 0, maybe 0.75, maybe the most expensive, I think 1.05, compared to the poison ones, which are about 3 to 4%. And then this is the key. There are only a few annuities out there that actually provide increasing income. So when you turn on this pension, this annuity, it's going to increase with inflation. So as inflation goes up, you have the ability to have your paychecks go up. And Doug, why is this so important? Because if you're retired for 25 or 30 years, it's a big deal.
It is. You have to have something designed to keep up with inflation because most pension plans are fixed. Most Social Security benefits, even though they have cost of living adjustments, tend not to be close to true inflation. And so you get a squeeze if your income is fixed as time moves on because things go up in cost. You know, our listeners have heard me say when I was in high school, gas was $19.9 a gallon. And so, you know, gas, we haven't seen gas under $2 a gallon in I don't know how long. And so you have to build that into your plan so that you don't get a lifestyle squeeze.
You don't want to be surprised. We're talking about the type of annuity or what you want in an annuity for your plan. If you don't have that, give us a call. The number is 466-5634. That's 466-5634 to sit down to see what is the right kind that would fit into your overall plan. And when we come back, we're going to talk about the kind of annuity you do not want. This is the annuity and the features that can be poison to your retirement. You listen to Chris Abeyta and Doug Berkey on Accelerated Wealth here on AM 740 KVOR. We'll be right back.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Hey, welcome back. You're on AM 740 KVOR with Chris Abeyta and Doug Berkey. You're listening to Accelerated Wealth, where you do get retirement confidence in the midst of an uncertain world. And today we're talking about annuities, the kinds that you want to be in to pensionize a portion of your nest egg, to provide the guaranteed lifetime income that you and, if you're married, your spouse will need and will want to be retired, stay retired, and enjoy retirement while you still hold investments that can grow with the market. And it's a combination of a well-thought-out plan that you're putting together. And that's what Doug and I do, is we help you put together a well-thought-out plan. And Doug, that's one of the things that's different about us than most advisors. What we find is there are a lot of people, and maybe you're listening right now, they come into our office and you've got a large stack of stocks, bonds, maybe mutual funds in your portfolio. You've done a fantastic job saving. I'm thinking of several individuals that just came in this week and, had $1 million in 401ks, IRAs, Roth IRAs, and yet they're all in mutual funds or some form of stock type of derivative. And the question that they have is, how do I retire on this? How do I turn this into security? How do I turn this into lifetime income and protect myself so that we can actually enjoy retirement, spend time with our grandkids, and find ourselves in just a really good place? And one thing we're finding, too, is I'm noticing a lot of people are very nervous. They've got their entire life savings. They're on the brink of reaching that peak of their entire investments, getting very, very close to retirement, and very concerned about another stock market crash. And that's what we're talking about today, is how do you take a portion of your nest egg, pensionize it, turn it into a pension so that over and above your Social Security, you're going to have the lifetime income for you and your spouse that you can never, ever outlive. If you don't have that right now in your retirement accounts, if you don't have that security and know what kind of income you're going to have in retirement, you're missing a very well thought out plan. And it's probably because your financial advisor or your stockbroker is a typical financial advisor or stockbroker. They simply sell financial products and hope that the market goes up. And what you need is somebody who specializes in retirement income strategy. And that's what we do here. Give us a call. We'll sit down, have a cup of coffee, walk through with you. We'll go through our 5.5 basket master retirement plan. And if you're one of the first 6 callers, we'll do that for you for free if you qualify. And you've got a nest egg that we can show you how to get where you want to go. 466-5634. Give us a call. Call now, 466-5634. First 6 callers will sit down. It's free to you. Again, 466-5634. Now, we've been teasing you about the kind of annuity that you might already have that's poison. And here's what you do not want. We just talked in the last segment, the kind of annuity that you do want. Here's what you do not want in an annuity. And the first thing is an orphan annuity. You do not want to go to a workshop or somebody's seminar or to your stockbroker and just say, I've been thinking about annuity. What should I get? What should I buy? And just, they say, well, how much of your money do you want maybe safe, or how much do you want an annuity? What are you thinking? And you say, well, maybe 10% or 15 or 20 or maybe 50%. And then you just buy an annuity without the intention of it being a part of an overall plan. Remember, the reason you would buy an annuity is protection from a stock market crash, but also how much income is it going to produce when you retire, but also throughout your retirement for your entire life. And if you don't have that as part of a plan, you shouldn't be buying one. You agree, Doug?
Absolutely. It needs to be intentional. It needs to fit into your overall financial plan, and it needs to be appropriate for you. And when you turn on that income is also critical, Chris, because we'll show you how to do it in the most tax-efficient manner so that we look at all of your assets and decide which income to turn on when that benefits you the most and potentially reduces your tax liability.
Got it. So number one, don't buy an orphan annuity just to buy one. And this is maybe how you've purchased a poison annuity. But the other thing is you do not want to buy it from a stockbroker or a financial advisor that has sold you mutual funds. And the reason is they're going to sell you the kind of annuity that you don't want to have. And Doug, what is that poison annuity that you do not want to have when it comes to your retirement?
It's a variable annuity, Chris, and it has to be sold by somebody who has a securities license. And so if you've been dealing with a broker or somebody that has been selling you your stocks and bonds and mutual funds, in all likelihood, that's the product you're going to end up with.
And I can't stand variable annuities. And by the way, I'm securities licensed as well. We have the ability to sell all kinds of different financial instruments and tools. But when it comes to building your retirement, you don't want to have a variable annuity. And here's why. Several reasons. Number one, what you're basically doing is you're putting an annuity or an insurance wrapper, which costs money, around a set of what's called sub-accounts, which are basically mutual funds inside that account. Well, if you've already got mutual funds, why do you want to put it inside of an annuity and be charged more in expenses? The typical fees for a variable annuity are about 3.5% to 4%. We see this every single week. People come in, they show us their variable annuity, and when we show them how it works, when we show them how much money they have pouring through the cracks, that they're losing, that they will never get back, and then when we show them that they can lose just as much money in that variable annuity as they can in a mutual fund, the question usually is, why did I do this?
Well, on this fee issue, Chris, many of those fees are hard to find. They're well hidden. But interestingly enough, one of the major companies that every listener would recommend or recognize if I said the name on this program puts out a prospectus. That prospectus is 364 pages long, and it takes 21 pages to explain the fees. 21 pages.
Wow.
Now, do you think most clients that bought that understood that?
Oh, I'm sure they read it before.
Oh, yeah.
Well, we had to buy it so that we could see what was in it, right? We're past it. So that's the thing. So if you're taking notes, you want to write that down. Variable annuity, no. If you've got a variable annuity, maybe you've had it for a while, you want us to take a look at it, there may be options on either how to optimize what you do have if you can't get out of it, because a lot of times once you're in, you're stuck. Or we've seen lately, because the stock market is up so high, many times the values inside those variable annuities have recovered, or they're at a point where you can actually get out of it with no penalty or a very small penalty and get into a position where you're more secure, stable, and even get into another type of a bonus annuity that is a right annuity for you that will cover the loss or cover the surrender charge. So that is key. You want to avoid those 3 to 4% in fees. Doug, this is something I saw the other day. I had a gentleman come in. We were analyzing his variable annuity. And when we got on the phone, we called the company, we asked about it, and he said, I asked, will this pay out income for both him and his spouse? And the gentleman on the other side said, no, I'm sorry, this is only single income. And the owner of the annuity said, what? I said, yeah, that if you die, your wife doesn't get any of the paychecks. And he said, I would never have bought that if I'd have known that. And I said, well, it's okay, we're going to fix it. And we fixed it for him. But you never, and if you're married, you don't want to get an annuity that only pays out single and doesn't cover a surviving spouse. So that's another thing you don't want in that. Here's another one. Doug, what's that next one that we see a lot of?
Well, one of the things that we see is most of those tools, when and if you can turn on income, it provides static income, Chris. The income is fixed. It does not go up. And what people also don't realize is that even though you may have an income rider on your variable annuity, if the market sees a major correction, you can see that income go down. We've seen that in some cases, and we actually got on the phone and talked to the home office of one of these big providers, and they verified that for the client.
So static income, and what that means is once you turn on an income, does it have the ability to go up with the cost of living, go up with inflation, or is it pretty much going to be static? And so what that means is, are you going to be getting the same paycheck the day you retire, and are you going to be getting the same paycheck 30 years from now while inflation has gone up? There are better tools. And so one of the ways that when we sit down and we evaluate annuities and evaluate the right thing into your plan is we take a look at what is the lifetime income that this annuity is going to produce. And we map that side by side from a static annuity to the type of fixed index annuity that will actually create increases over time. And many times we will see $1, $2, $3, even $400,000 more in income over your lifetime by choosing the right annuity that fits for you. So listen to this right now. Do not leave hundreds of thousands of dollars on the table when designing your retirement plan. If you don't have a plan, if somebody's not specifically designed a 5-basket master retirement plan for you, you're missing out on the security, and you could be missing out on $300,000, $400,000, $500,000 of income over your lifetime by choosing the wrong products in your retirement strategy. Give us a call. We'll sit down. We'll go through that. It's for the first 6 callers. The number's 466-5634. That's 466-5634, where you can reach us again, 466-5634. Doug, we've covered a lot of things today. We've covered the kind of annuities you want to be in, the kind you don't want to be in, the things you don't want to do. And these are complex tools. And one thing we find is you probably as an investor, as an individual, don't have the process or the step-by-step approach to know how to make sure that you're not missing something critical in your decisions. And that's what Doug and I do is when we sit down, we walk through a step-by-step process to help you identify what are the critical must-have pieces of information that you need in order to make the right decision for you. So give us a call. We'll be happy to help you with that. Again, the number's 466-5634 to give us a call here at Accelerated Wealth. We'll also see you on Monday morning at 8:10 on Money Mondays. Thanks for joining us.
The opinions on this radio talk show are those of Mr. Abeyta, Mr. Walton, and their guest speakers, not necessarily those of Accelerated Wealth, LLC. The radio talk show may contain forward-looking statements, including but not limited to statements as to future events that involve various risks and uncertainties. Forward-looking statements involve known and unknown risks, uncertainties, and other factors that may cause actual events or results to differ materially than those that were forecast. Therefore, no forecast should be construed as a guarantee. Investing in security and annuities involves a risk of principal loss. Prior to making any investment decision, a listener should consult a professional to determine the risk, benefits, fees associated with a particular investment. Info obtained by a third-party resource is considered reliable, but accuracy cannot be guaranteed.